Welcome everyone to today's webinar with Stephen Hall, CEO of NH3 Clean Energy. Stephen will be running through an investor presentation following yesterday's pre-feed results, providing insights to key findings and next steps. Please note that all attendees are in listen mode only. If you have any questions, you can submit them via the chat function at the conclusion of Stephen's presentation. I'll now hand over to Stephen to begin. Thanks, Stephen.
Thanks, Simon. Thank you, everybody, and welcome to this webinar. Delighted to be able to share with you the results of our pre-feed. The information I'm going to share, more detail is available in our pre-feed report, which we announced yesterday. I'll just draw your attention to our standard disclaimer before we start. And I suspect that most of you know who NH3 Clean Energy are, but if you don't, I just wanted to reinforce that we're a company focused on the Asia-Pacific demand for sustainable energy. What that means for us is low emissions, or what we call clean ammonia. And we're very much focused on delivering our flagship project, which we call WAH2, and that's what we're going to be talking about today. And the reason we've been able to achieve all that we have over the last year or 18 months is because of the world-class team that we've been able to pull together, and the strategic partnerships that we're building. So to hit the highlights, and then we'll go into a little bit more detail. We have completed our pre-feed technical work. We have a raft of preliminary commercial agreements in place. We've increased the production capacity of the project from 600 to 650,000 tonnes of clean ammonia a year. We've doubled the base case phase 1 NPV. And we've got a target phase 1 NPV, so geared and with some improvement opportunities, of 680 million at a rate of return of just over 15% real. The significant longer-term growth through phase 2 and the combined phase 1 and 2 NPV, we're targeting $1.1 billion for that. We have a data room open, and there are multiple parties in that data room undertaking due diligence on the project. We see multiple near-term re-rating events as we move towards feed entry in Q2 this year, supported by partner agreements, and our target for final investment decision is Q2 next year. So I'm going to start by talking a little bit about the market that we're aiming for. I'll then dive into the outcomes of our pre-feed, and then we'll finish with what does the way forward look like, and of course there'll be a chance for Q&A at the end. This chart summarizes the clean ammonia market. It's becoming increasingly clear that clean or low emissions ammonia is becoming a fuel of choice in terms of displacing hydrocarbon fuels. If you look at the graph, the light blue is the forecast clean ammonia demand, and you can see that it is growing very significantly. So to give you an idea, from basically nothing in 2020, you're looking at more than 30 million tonnes by 2030, and close to 200 million tonnes in 2040. And the value of that is substantial, as you can see on the top of the chart. 32 billion by 2030, and about 200 billion by 2040. Of particular interest to us, where we're located, is that it's the growth rate in the Asia Pacific that is particularly strong, and of course those are that's where we're looking to sell the majority of our product. And there are two markets that we're targeting, as you may recall. One is replacing coal in thermal power generation. That's primarily in places like Japan and South Korea. And the second is replacing fuel oil and diesel as a fuel for heavy shipping. And our focus there is very much on the export of iron ore from Western Australia. So the market is there and it's hungry. I guess if we're going to succeed, we need to be able to give the customers what they want. And it kind of boils down to these three things. They're looking for low emissions. Our emissions, in our base case emissions, are 0.38 kilograms of CO2 per kilogram of ammonia. That is about half of the threshold for clean, if you like, in Japan. So we clearly tick that box. In terms, they're also looking for supply that is cost competitive. Our economics are based on $600 a ton, US dollars a ton, I should be clear. And that is competitive into Japan. And finally, they're looking for secure supply. And if we look at Australia relative to the key areas of competition, which would be the US and the Middle East, you can see on the chart that we stack up favorably. We're actually the lowest geopolitical risk origin, if you like, for the product. We also have the shortest shipping distance, and the shipping routes do not have to pass through bottlenecks such as the Panama Canal. So giving customers what they want is clearly important, but of course we also need to be able to give them the product when they want it. And that's what we're trying to show in this chart, that our timeline, which has us having product to market in 2029, so before 2030, that aligns with the Japanese and Korean procurement processes. And that's for that power generation market we were talking about. It also aligns with the planned deployment of co-firing in coal-fired power stations in those markets. It also aligns with the development of ammonia-fueled shipping. And so just to say a little bit more about that, dual fuel engines have already been developed that can burn ammonia. And the first bulk carriers, i.e. the sort of ships that would transport iron ore from Australia to Asia, the first ammonia-fueled bulk carriers have been ordered and are expected on the water around 2027. So we're able to supply the key customers when they need it before 2030. The other point to note about our project is we've deliberately taken a phased approach. So we have phase one and then phase two. The reason for that is so that we can adjust the timing of phase two to react to the speed of market build-up. So it provides us with flexibility, and it means that we can tailor our production to the demand. This is an update of a chart we've shown previously, and the numbers in dark blue are the numbers as of about 18 months ago. And the story then was, look, in Australia, there's a lot of hydrogen-related projects, but there's only a few that are looking to produce clean ammonia, like we are. And there's, in fact, very few that are looking to do it using the technology that we've chosen, so gas with CCS. But if you look at those, we're actually unique. We're the only one of those that is close to all the things it needs, particularly an existing deep water port and multiple CCS projects. The light blue numbers are basically the same analysis, but done in December last year, at the end of last year. And basically, they show the same thing. We're still one of a kind in Australia, but we're one of a kind in a much slimmed down playing field, if you like. And a lot of projects have stalled or fallen by the wayside. Now, I would note that the majority of the projects that have stalled have been green or electrolysis-based projects because of some of the challenges that they've faced. This chart shows a bit more of a deep dive on some key competitors, both in Australia and we look internationally as well. So if we look at the timeline across the top, that's the stages of project development. And in Australia, I mean, the key takeaways from this are really there's the most advanced project in Australia is a small green project, Project Yuri in Western Australia. Its volumes are very small. It's essentially a pilot project, and it has received some government funding. The other green or electrolysis-based projects have hit problems. Most recently, the Stanwell Energy CQHQ, where Kansai Electric pulled out late last year, and the Queensland government recently said that it would not be funding the project. And so that really leaves, in terms of scale, ourselves as clearly the most advanced project in Australia. It's a pattern that's sort of repeated overseas, and if we look at the States, you'll see that it's really the gas-based projects that are advancing most strongly, and we've picked out a couple here. The OCI project that Woodside bought into last year for $2.3 billion US. And then, of course, we've got Exxon, JERA, and Mitsubishi in the Baytown project, not quite as advanced. The good news about this chart, if you like, is that if we think back to that market chart, it's a very large market and it's growing very quickly. So there is absolutely room for both US, Middle East, and Australian producers in that market. And we have had feedback from our various offtake discussions that Australia is seen as a valuable part of that supply portfolio. I'll now move to talk a little bit about the specific pre-FEED outcomes. First of all, just to remind you, our project is located in northern WA, close to Karratha and close to all of the key inputs that we need and close to infrastructure that provides value-enhancing opportunities. And again, to remind you of the value chain, we take natural gas as our primary feed. We also need some water for cooling purposes. We then bring those into a new build plant that we're constructing in the Maitland site. That turns the gas into hydrogen and then ammonia. Because of the way that we configure the technology, we can capture virtually all of the process-related CO2, which we will then compress and transport down a pipeline to a third-party sequestration site. And it's the fact that we've captured and sequestered that CO2 that makes our ammonia clean. That clean ammonia we will transport via a pipeline to the port of Dampier. And at the port of Dampier, it will be loaded onto a ship, either a gas carrier to take the ammonia to a market such as Japan, or a bunker vessel, which would take the ammonia to be supplied as a fuel to one of those iron ore bulk carriers. And you'll see from the logos on this chart that we've been working hard getting preliminary agreements in place across pretty much all of the elements of the value chain. I've got a couple of charts here that there's a bit of detail in this, and I'm not going to go through it line by line. But the point I'm trying to make is that we really have made a heck of a lot of progress through pre-feed. So in the sort of 15, 18 months that we've since we completed our pre-feasibility, it's a fundamental step change. And so in terms of land, we had at that time, we'd just been allocated land. Now we have a key terms agreement. We've interrogated baseline surveys and confirmed there are no significant issues. We have an option to lease agreed in principle, and so on. In terms of production, we've increased our production from 6 to 650,000 tonnes a year. And we've actually, in doing so, we have reduced our unit costs. I should also say that we've done it in an efficient way that means that our gas requirements, our feed gas, is only very slightly higher than it was before. So our plant is more efficient at taking gas as input and giving ammonia as output. At the time of PFS, we'd worked out that autothermal reforming was the way to go. What we've now done is we've got a very clear single design basis to go into feed, which is, of course, exactly what you want when you're going into feed. But importantly, that design preserves flexibility to adjust our emissions during the operational phase. We've got robust economics, and I'll talk a bit more about those on a following slide. And as I mentioned, we have a comprehensive data room open. The purpose of the data room is to share the technical and financial information about the project so that off-takers and potential strategic partners can have a good look at the project and then move forward with us. In terms of water supply, previously we had assumed that we would need to build our own desalination plant. Now that we've executed a key terms agreement with Water Corp, we no longer have to do that, and we've deleted that plant and the associated pipelines from our project scope. In terms of gas supply, at PFS stage, we've done our analysis. We understand the gas market, the WA gas market well, so we were confident that we'd be able to get gas, but we had to basically assume a gas price. Now we have non-binding agreements representing around 85% of our phase 1 requirements. And there is pricing in those agreements, and of course that pricing flows through to the economic analysis that I'm going to share in a moment. In terms of CO2 sequestration, we had assumed that we had to build our own CO2 pipeline. That's no longer the case. We have an MOU with AGIC, who will build, own, and operate that pipeline and charge a tariff for the service. And in terms of CCS, we've identified the options, and now we're well advanced in confidential discussions with each of those options to nail the CCS solution for us. And again, indicative pricing has been provided. If we then look at the final link in the chain, the export infrastructure, we'd selected a pipeline rather than another means of transporting the ammonia to port. We're now in a position where, you know, we've confirmed that the government's plan includes the pipelines we need, the infrastructure corridor plan, I should say. The government, and this is a combination of state and federal governments, have actually allocated funding to some multi-user pipelines that could help us. That sort of funding, by the way, has not been included in our economics yet. And we have an MOU with Pilbara Ports, which is all around exporting our product from the port of Dampier. What you can see from these slides is that there's an ongoing theme through this of getting the best people to do the job. So if I just pick an example of the CO2 pipeline, it's our view that AGIG, as a specialist pipeline and infrastructure company, are better placed than us to build that cost effectively on time, and it also helps our economics by taking capital out and replacing it with an operating cost. So to come to the economics, the base case NPV for phase 1 of the development is $493 million, and that's at a 11.6% rate of return. There are some infrastructure-related opportunities that we've identified and are progressing, and we can also project finance the product, or we expect to be able to, and that can lift those phase 1 returns. So the equity returns we're targeting are actually 680 odd million of NPV at a rate of return of 15% plus. You'll see that the pre-tax cash flow is around 300 million from phase 1, and of course that runs for the 25 years of the project. One of the exciting things about the market at the moment is that it's starting to grow quicker than people thought, and that increases the likelihood of phase 2. Now, if we assume that phase 2 happens 5 years after phase 1, and that we optimize the financing and so forth, we're targeting an NPV of 1.1 billion, and again, a rate of return of over 15%. That does assume that phase 2 happens 5 years after phase 1. I'm becoming increasingly of the view that the gap between phase 1 and phase 2 could be notably shorter than that. And of course, if we bring phase 2 forward, that increases the NPV of that on the project as a whole. So there's a lot of analysis behind these numbers. To pull out a couple of other points, we have done a lot of sensitivity analysis to stress test those numbers, and the tornado you see on the left is the phase 1 base case, so that lowest NPV number I showed you on the previous, and you'll see there that that NPV remains positive across all the sensitivities that we tested, and that includes, for example, a 30% increase in capex, or a $50 decrease in ammonia price, for example. One thing I would note here is that the way that we plan to organize our commercial contracts will help mitigate some of these outcomes. So, for instance, we would look to align our gas price, our input gas price, with our output ammonia price in various ways. There's opportunities that we've identified to boost value, and that's shown in the middle chart. And notionally, though, they add around 100 million of value, and lift returns also. Those opportunities relate to pipelines and infrastructure in various forms. And then the chart on the right shows the impact of project financing. So we've assumed a reasonably conservative 60% debt finance at an 8% real interest rate. And even with those assumptions, phase one NPV is increased by around 110 million in each of those scenarios, and the rate of return gets a boost of about 3%. So I'll just talk quickly about the way forward before I move to take questions. We have a very strong focus on minimizing execution risk. The punchline here is we're going to keep doing what we've been doing, and that's basically keeping things as simple as possible. By adopting those 5 principles you see on the left-hand side: proven technology, existing infrastructure, established providers, global practitioners, and maximum modularization. On the right, you'll see the logos of the various companies that and entities that we're working with. So we've now, just looking at our timeline, we've now finished pre-feed. You can see that there's a lot of stuff that we've done. We have the key partnerships in place that we need to move forward. We're still in some discussions around strategic partnerships, and that's why we've opened the data room. On the right-hand side, you'll see that the scope of feed, and as I mentioned earlier, we're looking to complete feed in the second quarter of 2026, which would then support a final investment decision. And so just thinking about the next 12 months from a couple of perspectives. And on the macro side, we've got the Japanese and Korean procurement processes progressing. We've got the implementation of ammonia co-firing, and we've got the increasing definition on the plan for bunkering in the Pilbara. Sorry, that's clean fuel bunkering in the Pilbara. In terms of the project, we'll complete the remaining provisional agreements. We're looking to secure strategic partners and offtake, and then definitive input contracts to support FID at the end of FEED. In terms of engagement, we'll be increasing our engagement with governments, and we are seeking the project to be recognised in the WA government's lead agency framework. And we're exploring potential options for financial support. And then in terms of corporate finance, we're progressing project financing through various discussions, and we're looking to increase our equity market reach to get company level value recognition for the project. And I'm sure it's not lost on you that there's a stark contrast between the current market cap of the company and the NPV of the project that we're progressing. I will leave it there and look forward to your questions.
Thanks, Stephen. That was a great run through of the presentation. Just to everyone out there, that concludes Stephen's presentation. So if you've got any questions, just please type them into the chat now. I've got a couple come through already, actually. How does the IRR stack up against similar infrastructure projects? So, for instance, oil and gas project.
Pretty well. I mean, oil and gas is quite a sort of a broad church, if you like. There are several major companies that have published their investment criteria, and the sort of numbers you'll see are people would look for a 15% return for an oil project, which tend to be relatively short-lived and are peaky in their profile. For gas projects, it's typically 12%. And that's because they're a more substantial investment, but they give you, a couple of decades of secure cash flow. When it comes to the new energy space, several companies have suggested that 10% is a sensible number or an appropriate number. So if you look at our returns with the base case for phase one, we're saying is 11 and 11.6, and with project financing, that comes up to maybe 14, and with some improvement opportunities, that could come up to 15. I think it stacks up. I think it stacks up very well.
All right. Yeah, well, I've got quite a few coming through, Stephen. So what is your CCS solution?
There are two nearby CCS projects, but both in the public domain. One is the Santos owned and operated Devil Creek Reindeer project. The other is the Woodside operated Northwest Shelf Angel project. We are more or less equidistant between them. One of them is 30 kilometers west of us, and the other is about 37 kilometers north of us.
All right, thank you. I'm just going to try and merge a couple of these because there's a few here. I guess there's a question about funding and whether or not you're engaging with NAIF and EFA for possible funding support. And do you still plan to sell down 66% at the project?
Okay, let me try and answer that one. So, I mean, questions on the financing are probably best directed at our chairman, and we'll make sure there's an opportunity to do that in due course. But I mean, what I can say is that the capex is going to be funded at the project level through a combination of project finance, debt, equity, and strategic partnerships. And the purpose of the pre-feed technical economic analysis and data room is just to provide the supporting data to progress those sources of funding. So the first round of folks in the data room are potential strategic partners and off-takers. And then the next round will be energy transition, and infrastructure-focused project finance funds. I think you mentioned NAIF. We have had discussions with NAIF, and we expect those to continue.
Beautiful. The federal government H2 production tax credit scheme, will that apply to the project? Do you know?
The honest answer is I don't yet know. And we haven't factored any benefit from it into our economics. One of the reasons why we don't yet know is that the wording is a little unclear. On one hand, the wording said, and there's been a consultation paper out about this, as you probably know. On one hand, the wording says we're technology agnostic, which would imply that we're in. In other places, the word renewable is used, which might imply that we're out. And so we are seeking clarity on that. It's also not clear what the final threshold criteria are going to be in terms of emissions intensity. But that is one of the reasons why we have preserved flexibility to change our emissions, to lower our emissions in the operational phase, because customers might change their view of what they want, and the government might make clear that some level of emissions performance warrants some sort of government incentive. So we want to be in a position where we can adjust our project to make the best use of such things.
All right, thank you. I've got still quite a few here. What would be the best market comparative for market cap as a discount to pre-feed NPV? Are there any in a similar segment?
That's an interesting question. I think the short answer is no. If you look at us in Australia, I think we're one of a kind, and you know, I think I talked a little bit about why we feel that. The other issue that we've got is that there's been a lot of negative sentiment about green hydrogen projects in terms of, you know, are they really going to be viable and are they the solution? And that's an interesting question, because on one hand, that absolutely reinforces the strategy that we took, which is, look, we don't think green electrolysis based is going to be economic anytime soon, though we certainly don't rule it out in the future. The pragmatic way to deliver clean energy that customers can afford is to do it using the technology we're doing. So, you know, the fact that green projects are falling by the wayside really reinforces the sense of the approach we've taken. The problem we've got is that I think a lot of people don't differentiate necessarily between us and those green projects that are falling by the wayside. So part of our challenge is to do a better job of communicating that, because I mean, coming back to multiple, I mean, you know, if we're looking at a project that of 500 million-ish in a base case, with improvement opportunities, and with phase two, you're sort of up at $1 billion plus. And then you look at our market cap, I mean, you know, and we're at our stage of development is we've completed pre-feed. I find it very difficult to reconcile those two. You know, the probability, I'm not going to give you a particular probability, but the probability that I would typically put on a project at the end of pre-feed, and I, you know, use that to risk the value of the project, I get a value much higher than our current market cap.
Thank you. Look, there's probably going to be too many to get through all today, but I'll probably do 2 or 3 more. Stephen, are you happy with that? Have you got time?
Yeah.
Yep. How does the NH3 project compare with the Woodside project that they paid over $2 billion for, according to your chart, or the chart that you had up earlier?
I mean, the similarities are they are basically using the same technology as us. They are, you know, so they're taking gas, they're using autothermal reforming to turn it into hydrogen and then ammonia. They are looking to a third-party source of gas like we are. They are looking to a third-party CCS provider like we are. And they are targeting the 2 same markets that we are. So in other words, the power, you know, displacing coal in power, and displacing diesel in shipping. So there's a heck of a lot of similarities there. I mean, you know, the obvious differences are that they're in the US and we're here. So, you know, there is gas in the US is often cheaper, but not always the case compared to WA, and it's certainly a lot more volatile. That would be one difference. They have a significantly longer shipping distance, so we have a clear advantage there. There are some government incentives in place in the US, but of course that's all a little bit up in the air at the moment with the with the change of administration over there. I think one of I don't have any inside information, but I mean I would assume that one of the reasons why Woodside was keen to buy into that project was that it's at a very advanced stage. So it's already in construction. And I think in this market, there are some clear advantages to being a first mover, or I should say an early mover. And of course, that's the position that we believe we're in and that we're looking to maintain and make the most of in Australia.
All right, I think I've got two more here, Stephen, that are nice questions. What do you consider the greatest risk to project execution?
Keeping everything coordinated, I think. So, I mean, we've sometimes shown a chart that sort of shows all the different pieces of the jigsaw that we're looking to pull together here, and each individual piece, there's nothing unusual about it. Proven technology to make the ammonia, a CO2 pipeline, an ammonia pipeline, gas from existing infrastructure, use an existing port. All of those elements are very straightforward on their own. But the challenge, of course, is to bring all of those things together at the right time. And that's something that we are quietly confident about, but I would say that's probably the key challenge.
Okay, thanks, Stephen. Well, one final question here. I think this is a good one to end on. What is likely to be the first signal that you have interest in the project post the data room being open? How many ammonia projects do customers have to choose from at this point?
I can't really say what's on a particular, potential partner's radar, because different companies have different preferences in terms of exposure to this, that, or the other. What I would say, though, is we're getting consistent feedback that Australia is a valued part of the portfolio. And then we're increasingly confident that if you're looking for short-term supply of clean ammonia from Australia, that it's a very thin playing field. I mean, I struggle to see a very credible alternative.
Yeah. So I guess,
themselves.
I mean, sorry, just to interject. So there's people, you've got strategics in there in the data room now. What has been that feedback? I guess that's sort of what I was thinking.
Okay. I mean, obviously, I can't talk on specifics because
No.
they're confidential. But if I picked out three themes, maybe it would be our keep it simple, pragmatic approach is really resonating with people, and they've frankly been impressed with what we've achieved over the last sort of 12 to 18 months. Secondly, they're impressed with the quality of the technical work, and of course that's very much a team effort between ourselves and Petrofac and Topsoe. And the third one is that they look at our cost of supply as competitive.
Yep. All right. Thanks very much, Stephen. I know we bombarded you there with a few questions, but you did an excellent job. And thanks everyone for joining today's webinar. And that wraps things up. Obviously, management is available via email and things like that. So if you have anything else to ask, just flick it through via email.
Yeah, and Simon, if I could just sort of thank everyone as well who's
Yep.
taken the time to join the call. And I know you've got other pulls on your time. Appreciate your interest in NH3 and hope that you'll stay engaged and be tracking our progress closely.
Thanks, Stephen.
Thank you very much.